Buddy, today we will discuss about the wealth tax. The contents in this PPT are: we will discuss about introduction to wealth tax and its meaning, scope of wealth tax, and institutions exempted from wealth tax, features of wealth tax. Now, introduction and meaning. What is wealth tax? Wealth tax is a form of direct tax. We all know that there are two type of taxes which are charged in India: direct tax and indirect tax. Direct tax is a tax which the burden of which is fall on the assessee, that is the person who has income or who has wealth, and it cannot be shifted to another person. For example, income tax, wealth tax, etc. Indirect taxes are the taxes the burden of which can be shifted to another person. For example, now GST is one of the most important wealth tax, most important indirect tax which is being imposed in India. Wealth tax is a direct tax. It is imposed on the net wealth of a person. A person is liable to pay wealth tax if its net wealth is in excess of rupees 30 lakh. Rate of wealth tax is 1% on excess amount of rupees 30 lakh. For example, if a person is having a wealth of 50 lakh, then up to rupees 30 lakh the tax will be exempted, and he will be have to pay tax of rupees 1% on a net wealth of rupees 20 lakh, that is wealth exceeding rupees 30 lakh. The levy of wealth tax was introduced in India following a suggestion made by Dr. Kaldor in his report on Indian tax reforms. The Wealth Tax Act 1957 came into force on April 1957 and applies to whole of India including Jammu and Kashmir. Now we will discuss about the scope of wealth tax. According to Wealth Tax Act, tax is imposed on following categories of taxpayer. First, individual; second, Hindu undivided family; third, companies. What is an individual? Individual is maybe a male and female whose exempted income exceeds rupees 2 lakh 50,000. In case of wealth tax, if its wealth exceeds rupees 30 lakh, then he will be charged to wealth tax. Hindu undivided family. It is a family ancestor which is having an ancestral property, and Karta is the head of the family. Companies, according to Companies Act 1956 or Companies Amendment Act 2013, company is an entity or artificial person which is created by law, having separate legal entity, continuous succession, common seal of its own. It may be an Indian company. Some institutions which are exempted from wealth tax. Now, next topic. According to Section 45 of Wealth Tax Act, following institutions are exempted from wealth tax. That is, they are not required to pay wealth tax on their wealth. First, companies which are registered under Section 25 of Companies Act 1956. Second, cooperative society. Third, social club. Fourth, political party. Fifth, mutual fund under Section 10, subsection 23D of Income Tax Act. Now, what are the features of wealth tax? First, applicability. Wealth tax applies to whole of the India, including Jammu and Kashmir, since April 1, 1957. Taxpayer. As per the provisions of Wealth Tax Act, the taxpayer is an individual, Hindu undivided family, or such companies not having substantial public interest. That is, already we have discussed that three persons are required to pay tax. First is individual, second is Hindu undivided family, and third are companies. Next, direct tax. We all know that wealth tax is a direct tax because the burden of wealth tax is to be borne by the assessee himself. That is, a person who is having wealth above rupees 30 lakh is required to pay wealth tax. Assessee cannot shift his burden to any other person. Now, exempted limit. In this act, there has also been provided an exemption limit of wealth tax. That is, the wealth tax is levied if amount of net wealth exceeds rupees 30 lakh. Next, tax rate. There is no slab in the rate of wealth tax. It is only of one type. For example, in case of income tax, we are having different tax slabs, and it is known as slab system of tax. But in wealth tax, there is no slab. It is only one slab, that is rate of wealth tax is 1% on excess amount of rupees 30 lakh. Basis of charge. Wealth tax is charged on net wealth. It is aggregate value of all the assets as computed under the Wealth Tax Act in excess to the aggregate value of all debt owned by the assessee on valuation date. That is, wealth tax will be charged on your net wealth. We will calculate the assets of the assessee, and then all the deemed assets will be added to the wealth of the assessee. Then we will deduct all the debts owned by the assessee on such assets, and the left value, that is net assets, will, if they exceed rupees 30 lakh, then 1% wealth tax will be charged. Administration of the act. There is no provision for the separate appointment of the officers for the administration of this act. The administration of wealth tax act is governed by income tax department and their authorities. That is, there is no wealth tax department. That is, income tax department look after the wealth,